Yo people, welcome to the video. Now unfortunately I'm going to have to start this video with a little bit of a warning because it seems like already my comment section is flooded with these weird, scammy, fraudulent comments, and although I'm sure a lot of you are already aware and wise to this, I just want to make doubly sure so that nobody actually falls for this shit. So the first is an account or accounts pretending to be me, using the same profile picture and account name and giving out a phone number and saying, yeah, WhatsApp me, and I assume at some point this person is going to ask you to send them money. This is not me. I am never going to give you my phone number in a YouTube comment. I'm not going to ask you to send me any money, and I'm not going to pretend to invest it on your behalf, right? The second kind I want you to be aware of is a little bit more inconspicuous. It's usually what looks like some kind of innocent exchange between 2, 3, even 4 accounts sometimes, which makes it look more realistic, where the first will say something like, oh, I thought investing was really confusing and difficult, but then I found out it's quite easy to make money. And then the second will say, oh really, how did you do that? And they'll say, oh, I use an experienced broker, I use such and such. And then someone else sometimes will then come in and say, oh, I've heard of them, they're supposed to be really good, right? So it's supposed to, you know, lend weight to it and make it seem more realistic. This whole exchange is completely fake. They are everywhere, just watch out for them, don't get sucked into it, right? Now that's done, we can actually get on with the video. Now let's talk about index funds. I'm going to tell you what one is, how they work, how I invest in them, and how you can use them to hopefully increase your wealth. So first of all, let's start with what actually is an index fund. So there are a few different types of funds you might have heard of, and I'm actually not going to go into all the differences and similarities between them in this video because I don't want to get bogged down in too much terminology and confuse you right out the gate. Broadly speaking, a fund is when lots of investors pool their money and then collectively purchase shares. There are actually other types of funds such as bond funds, so not strictly shares, but in this context we're talking solely about equities, so stocks and shares as in an equity share of a company. So they do this partly because it makes it easier to get exposure to lots of different stocks, and partly because it's often a much cheaper way of doing things. And by cheaper, I mean it is cheaper to buy and sell your stake in the fund than it is to buy and sell lots of different shares of different companies. So the fund itself owns the shares, and then you own a stake in the fund. So that's the fund part of the term dealt with. Now, funds that focus their investments on particular indices, or singular on an index, are therefore called index funds. So now we need to know, what is an index? An index is just a group of stocks that are supposed to give a representation of the stock market as a whole, or of a particular sector of the stock market, with the most well-known ones representing the respective geographies. So it might just be easier to give you a couple of examples. The FTSE 100 is probably one that you've heard of, and that is the top 100 companies listed on the London Stock Exchange. And by top 100 I mean largest market capitalization, so the amount of shares multiplied by the share price. The FTSE 250 is the next largest 250 companies by market cap, so that's not including all those in the FTSE 100. And one you might have heard of in America is the S&P 500. That is 500 companies listed on US exchanges, but not necessarily the 500 largest by market cap. Instead, companies included in that index are actually decided by a committee who do take into consideration things like market cap, but it's not the only factor. So some indexes are determined solely by hard and fast rules, such as the FTSE 100, and some are actually decided by a group of fellas probably sat in a room somewhere, right? Although they will take into consideration things like market cap, etc. Other examples include the DJIA, the Dow Jones Industrial Average, the DAX, the Hang Seng, the Nikkei 225, etc, etc. All you need to know is that these are really just names for groups of stocks, and they are not to be confused with stock exchanges such as the London Stock Exchange or the New York Stock Exchange, which is an actual physical place that exists on Wall Street. So how do they work? Well, what an index fund will do is purchase shares to mirror the index that it is supposed to track. And that is why you sometimes hear index funds referred to as index trackers or tracker funds. So for example, if I have some money in an index fund that is supposed to track the FTSE 100, that is akin to having money spread around all the different companies in the FTSE 100, right? Therefore, if, for example, the FTSE 100 grows by 10% this year, then hopefully my money in that fund will also grow by around about 10%. It's going to be there or thereabouts. It's often not going to be an exact mirror for a few reasons that I might get onto, but it's going to be close enough. So why would you just want to match market performance? Well, because that might be better than the returns that you could get otherwise, right? It is notoriously difficult to make money in the stock market by picking individual stocks, right? Or even by entrusting somebody else to do it on your behalf, right? So Google spits out the statistic that 90% of people lose money in the stock market. I'm not sure how accurate that is. You know, that's first page of Google stuff, right? It might not be particularly accurate, but studies have been done comparing the performance of professional fund managers, or people who pick stocks for a living, against index funds, and they found that these fund managers can't actually consistently beat index funds, yet they are a lot more expensive as a service. So think about it. If these people who do this for a living, who have all of these resources at their disposal to do their actual legit intensive due diligence, if they can't beat index funds, then what chance have you really got? Because you might feel like you've done a lot of research, right? You might do your first page of Google due diligence, right? But think about people who do it for a living. They've got people like flying out to check crop yields in Africa, mate. Do you know what I mean? You ain't got those kind of resources and that kind of time. And if these people still can't beat or consistently beat index funds, it doesn't really bode well for you, like no matter how much, you know, you read stuff on Reddit or whatever. Now, you might be forgiven for thinking that it's easier to make money in the stock market than it actually is, because of the kind of availability bias of information you get out there, right? Because people will shout about their wins, but nobody is posting a screenshot on Twitter of their account like 20% down in the day. No one takes a massive loss and goes, oh shit, look at this, look what I did today. Do you know what I mean? Everyone just publicizes the wins. You also have to consider the general market trend since like March 2020, right? Since that big dip, it's pretty much been booming, right? So it's not that hard to make money when everything is going up, right? And then even if you can beat the market, not many people have the time to actually dedicate to managing their investments, right? Because it's not just about your initial investment, researching the company that you're going to invest in, but also keeping on top of that and staying on top of anything that's happening with that company within that sector or industry that might affect the future share price, right? And that's like a full-time job. Aside from the actual performance, that's not the only thing that's going to affect your returns, right? Because there are also fees and costs involved in investing, right? And some brokers will charge a flat fee per trade, some will charge a commission, and some will make money on the spread between the actual price and the price at which you can buy shares at, right? And on top of that, if you have your money in a fund that is actively managed, then the fund manager needs paying, right? So this all just means that you need to make a higher return to factor that in before you can calculate your actual take-home return. And that's why for the vast majority of people, just investing in index funds is going to be by far the better option, because there are still risks involved, there are still costs involved, but both the cost and the risk are pretty much there or thereabouts, as low as you can get with any kind of stock market investing. Now, of course, the potential upside is also lower, because let's face it, some individual share prices will run up hundreds or even thousands of % over the course of a year, whereas an index as a whole is never really going to do that. So you do cut yourself off to those really astronomical gains, but the chances are, statistically speaking, you probably wouldn't have got them anyway. Like, cue everyone telling me how they got them, right? Fair enough. If you did, I'm happy for you, but I'm just saying, statistically speaking, like talking to the majority of people, you know, I'm not saying it's impossible, I'm just saying most people won't. So how do you actually invest in index funds? Well, to begin with, there are three main decisions that you need to make. The first is the type of account that you're going to use. So for most people, if you haven't already opened or paid into a stocks and shares account this financial year, then I would advise that you use one of those, because then any gains that you make within that account are completely protected from any capital gains tax or any dividend tax. Now, of course, there is a limit of £20,000 currently on what you can contribute to an ISA within each financial year. Most of us aren't really going to get to that limit. Now, if you already have opened or paid into a stocks and shares ISA this financial year, you can just use a general investment account. And although technically gains in that account are going to be subject to capital gain tax or to dividend tax even, most of us still won't end up paying any, because you do have a capital gain tax allowance of £12,300 and also a dividend allowance of £2,000 per year. So further to that, your capital gain tax is only actually paid on realized profit. So even if your account itself made a lot of gain, you would only start paying capital gain tax if you actually sold your shares in that account and realized that profit. Now, I'm in danger of digressing a little bit too much, so I might just do a separate video related to tax efficient investing. The second thing to think about is which broker you're going to use. Now, this should primarily be determined by the fees, but also maybe by the funds that are available through that broker, and maybe even just how much you like the platform. Now, one of the most popular and the one that I use is Vanguard, which was founded by a guy called Jack Bogle, who is actually, he's now dead, RIP, was actually the inventor of index funds, right? But I'm not saying that's the one you should go with. It's probably also worth checking out Fidelity, Interactive Investor, even Hargreaves Lansdown. You know, check a few out, do your own research, right? Lastly, you have to decide which actual funds to invest in, because even within the realm of index funds, there are still varying degrees of risk and potential reward. Now, think about a tracker that tracks the FTSE 100 compared to the FTSE 250. So typically companies in the FTSE 100 might be more well established, they might be considered safer bets. However, they probably also have less room to grow than those smaller cap companies, and if they have less room to grow their profits and revenues, then also their share price will hopefully be in line with that. And so you might think, oh, I'd rather be invested in the smaller cap companies and just have that little bit extra risk just for the sake of the chance of a little bit extra reward. Right now, you can also think about geographical diversification. The S&P 500, for example, has been pretty much on fire this year, so you might want to get involved in that. Or you might think that a lot of the companies in the S&P 500 are overvalued and therefore it's the highest risk or the greatest potential for a bubble, right? Now, as ever, I'm not going to tell you which to invest in, because apart from actually being a genuine beginner myself, well, I think that's the main reason, really. I would also never tell you what to actually do, and I also think that it's just a good habit for everyone to get into doing their own research and making their own decisions, right, and taking responsibility for their own decisions as well. Now, that being said, as ever, I will show you what I'm invested in. So here are the actual funds that I'm invested in. So as I said, I use Vanguard, and these are my current holdings. They do need a little bit of rebalancing, but they're not actually far off where I want them to be. So it's there or thereabout. Now, as I said, I use Vanguard, so I'm just going to briefly show you the actual process of opening a stocks and shares ISA with Vanguard and investing in index funds. So go to vanguardinvestor.co.uk, make sure you get the UK site, and then what we offer: Vanguard ISA, open an account, start my application, and then go through and fill it all in. Eventually you'll get through to a screen where you can choose your investments, and it will look like this. Equity funds is what you want. Fixed income funds are bonds, and blended funds are a mixture of either a few different equity funds or a combination of equity and fixed income funds. If you do really want the laziest option, then you can just go for one of these life strategy funds, and I would personally say the 100% equity fund is best if you're young, because that is, well, it's 100% equity, so you're not actually getting any bonds within that. Bonds are typically used for people who are getting to an age where they're thinking about drawing down on their investments, and therefore they want lower risk. And so, for example, if you're 70, you're about to pull all your money out of your pension or whatever it is, or start pulling it out, then you don't want to be overexposed solely to equities in case of a crash that will obviously just destroy your pension. So then what do you do? Well, I would recommend just setting up a monthly direct debit for whatever you can reasonably afford and keep contributing to that account. Now, make sure that you are actually purchasing funds with the money that you deposit in that account, and you're not just leaving cash sat there doing nothing. Now, you do have a £20,000 ISA allowance per year, but you would have to contribute almost £1,700 per month to actually hit that limit. So I assume most people aren't going to do that, right? So then just keep it ticking over, keep contributing, try not to look at it too much, maybe go in once in a while and rebalance if and when you need to. If the market goes up, keep paying in. If the market goes down, keep paying in. No matter what happens, just keep paying in. And then 10, 20, 30, 40 years later, check it and be glad that you started now, right? Now, despite all the positives that I've talked about, there's certainly drawbacks in relation to index funds. They're certainly not perfect, right? And one of the main complaints you hear is that a lot of index funds actually operate with what's called a capital weighting rather than an equal weighting. So that means larger capitalization companies, bigger companies, will occupy a larger proportion of that index fund, which means that, again, like I mentioned earlier, you might be overexposed to larger companies that may theoretically have less potential for growth, and therefore the share price may have less potential for growth, and underexposed to those smaller companies that might experience more rapid growth, right? Now, you can obviously get equal weighted index funds, but there are still issues, right? So, for example, maybe you can get better returns elsewhere while still benefiting from similar levels of diversification, for example, through things like ETFs. Now, I'm not going to go into index funds versus ETFs right now in this video, but if you want me to do a video on that, I will do it. I do just want to say that index funds overall are a great way for people to invest in a low maintenance, low cost way to try and build some wealth over long periods of time, but they're certainly not the be all and end all. So that's it for now. I hope you found this video helpful. Most of all, if you do want me to do a video either comparing different specific index funds or index funds versus ETFs, then let me know. I can do it, right? So thanks all for watching, thanks all for liking, commenting, you know, all that kind of stuff, subscribing. I appreciate it. Obviously this channel is just a bit of a side thing for me, but you know, it seems like people are enjoying it, so I'm enjoying it too. See you next time. Peace.